If we look at a heat map of the S&P 500 year to date, it's just been a phenomenal year. It's been difficult not to make money. Obviously, tech stocks have done very well, financials as well. Even healthcare is starting to bounce back, and utility stocks have seen a huge run up as well. In fact, the S&P 500 is now up over 14% year to date. But like always, even in the midst of this run up, we still have stocks trading very close to their 52-week lows. Now, it is important to remember that a stock hitting a 52-week high can still be cheaper than a stock hitting a 52-week low. Stock price does not equal intrinsic value. But with that being said, looking at stocks trading at a 52-week low can be a great place to start searching. So in this video, we'll be doing exactly that. We'll be looking at two different stocks, and one of which is an extremely high-quality company. And to analyze these stocks, we're going to be using ProView.ai. I've used a lot of AI tools to try and analyze stocks, and so far I think this is one of the best. You can sign up for ProView using code DIVIES. There's only 50 spots available. Keep in mind this is desktop only. Thanks to ProView for sponsoring this video. Now, as we dive into the two stocks we're looking at today, it's important we get a macro overview of the US economy. I'll simply just run the macro prompt for the United States and hit enter, and what we can see is a few quick takeaways. Right now, the odds markets are currently showing 75% odds that we get a rate cut in December. Now, for reference, that would be the third rate cut just in the last few months, which is certainly bullish for stocks in general, but even more so for dividend stocks. And what's interesting about this is the Fed is currently expected to do this despite the fact that the government shut down since early October, created permanent blind spots in economic data. So let's look at our two dividend stocks. And the first one we're going to be looking at is none other than Costco Wholesale Corporation. If you've been keeping up with this stock, they've been on an incredible run over the last 5 years. They went from trading in the low 300s in early 2021 to trading as high as over $1,000 a share earlier this year. But then the sell-off started. Year to date, they're down by about 3.29%. Now, if you're wondering what the case is for the sell-off, I gave ProView a simple prompt. Why is Costco sold off? And they stated the primary reason is valuation concerns. And personally, I couldn't agree more. If we look at the valuation for Costco, what we can see is, on average, over the last 5 years, their forward-looking PE multiple is sitting at about 42.79. But even with the sell-off over the last year, the current forward-looking PE multiple is still sitting at 44.76. That's an incredibly high PE multiple. Now, we do have to remember the PE multiple by itself doesn't necessarily tell us everything we need to know about the valuation itself. We also have to account for earnings growth. So let's see how fast Costco is projected to grow earnings. And what we can see if we come down here is through the year 2029, the projected EPS CAGR is showing about 8.5%. And in reality, it's in the upper single digits, closer to 10% over the next few years. So yes, that's certainly decent growth, but 10% earnings growth for a stock trading at a 40 to 50 PE multiple, you can see why there's valuation concerns. Now, with that being said, Costco is absolutely one of the highest quality stocks out there. Let me show you what I mean. On ProView, if we jump over to the Playbooks tab, let's search for Costco. And what we'll be able to see is an in-depth breakdown, and in particular, we want to look at the recent quarterly earnings report. And one of the things that I absolutely personally love is the fact that I can jump straight into the presentation, one of my favorite things to read. And there's one key metric that I pay attention to every single quarter when it comes to Costco. And this is the metric that really makes them such a high quality company. It's their membership renewal rate. So let's ask ProView what that was in the US. And immediately we can see the key data that we need. In fiscal year 2025 Q1 for Costco, the US and Canada membership renewal rate was 92.8%. That's absolutely incredible. Now, the end result of this high level of membership renewal is incredibly predictable cash flows. For example, if we just jump over to the stock screener, let's look at Costco. When we look at Costco's revenue per share and earnings per share over the past decade, what you're going to see is, in reality, one of the most beautiful charts you can see in finance. Essentially, every single year, we're going up and to the right. The same is true with EPS. We can see we went from about 469 to growing every single year, and at the end of 2024, 1660. So we got close to a 4x in a 10-year time period. Now, when it comes to the PE multiple that stocks deserve to trade at, yes, obviously, earnings growth is the number one thing to consider, but probably coming in at number 2 would be the predictability of future cash flows. How certain can we be that future cash flows will continue to grow at a healthy rate? Now, when we think about pharmaceutical stocks, a lot of the times there's not a lot of predictability. These companies have to run expensive trials, they can lose patents. There can be a high level of variability with future cash flows. But with Costco, you're talking about one of the most predictable cash flowing businesses out there. And this is a large part of the reason that the PE multiple is often so high for this company. We can see from 2015 to 2023, the membership renewal rate was about 93%. And in this most recent quarter, again, about 92.8%. So it's remained virtually unchanged now for essentially a decade. If we scroll down, we can see worldwide it's slightly lower, but it's still above 90%. These are membership renewal rates that most subscription businesses would dream of. But here's what's so interesting about these membership renewal rates. If we actually jump over to the earnings deck, scroll down, look at this right here. Membership income growth was up 10.4%. How is it possible for membership renewal rates to essentially remain the same and membership income growth to be in the double digits? Well, it's actually pretty simple. Costco enjoys incredible pricing power. And in September of last year, 2024, they announced they're going to raise its annual membership fees for the first time in 7 years. They increased the annual charge to $65 from $60. Now, that seems minimal, but it's an 8.3% cost increase. And because they were able to increase prices by about 8.3%, really without seeing much of a change in their membership renewal rates, it caused a surge in membership income growth. Now, keep in mind, along with this, historically speaking, Costco has been a dividend grower. While the starting dividend yield is obviously very low, what we can see when we look at the dividend history down here is there's a clear pattern of dividend growth. But what's going on here? Well, essentially, Costco has a pattern of generating a lot of free cash flow, and when the time is right, using that free cash flow to pay out massive special dividends. The last time they did this was in 2023. Now, let's take a minute to actually talk about the valuation for Costco. Is the stock now more attractive since it's sold off about 8% in the last year? The obvious answer is yes, it's a bit more attractive, but doesn't mean it's an opportunity. For Costco, let's use a reverse discounted cash flow analysis, and this will reveal how much of a premium the market is actually valuing Costco at. For example, if we assume 0% free cash flow growth, the stock is worth about $207 per share, which is obviously considerably lower than the current share price. But if we bump this up to about 10%, which again is somewhat close to projections, the company would be worth $413. If we bump it up to 15%, $582. At 20%, we're still not there, but we start to get close. And once we get to around 21%, we get very close to the current share price. 21% free cash flow growth. That's faster than stocks like Microsoft and Visa. To make it even more interesting, I asked ProView to run a peer comparison for me, and we can see the forward PE of Costco compared to some of their peers. Obviously, they're trading at a significantly higher PE multiple, and yes, they are expected to grow earnings at a bit of a faster rate, but probably not enough to justify that much of a premium. There's no doubt the business model is significantly better than BJ's Wholesale or Target, and probably even Walmart. While I'm certainly a huge fan of the business model and just the quality of the business in general, I'd still need this one to sell off more for me to consider adding it to my portfolio. Now, the second stock on our list is Home Depot. They're down significantly in the last year, 21.5%, and year to date down 13.5%, and look at them in just the last month now, down 13.3%. And this is a company that, historically speaking, has been a phenomenal dividend growth stock. We can see that starting dividend yield is sitting around 2.7% with a 10-year dividend CAGR of above 14.5%. So back in 2014, they're paying out about $1.88, and by 2024, it was sitting at $9. That's the snowball effect taking place. Just imagine what's happening if you're reinvesting those dividends as well. And along with this, they're obviously growing free cash flow, which is backing that dividend growth. The dividend looks healthy and sustainable with a free cash flow payout ratio of just 54.7%. So the question we have to ask is, why has Home Depot sold off as much as it has in the last month and really in the last year now? And again, ProView does a great job of breaking this down. I asked, and they delivered. To start, when we look at the recent earnings report, comparable sales declined 1.3% overall, with US comps down 1.2%. So we're seeing declining same-store sales. Now for reference, this actually is an improvement from Q2 of 2024 when they saw a 3.3% decline, but it's still negative growth. Obviously not what we want to see. But it actually gets a bit worse. Customer transactions were nearly flat, while the average ticket declined slightly to $88.65 from $89.36 year over year. So we're talking about a triple whammy. Comparable sales were down, there weren't more transactions, and the average ticket price of the transactions that actually happened was down as well. Now keep in mind, historically speaking, the gross margins for Home Depot have remained pretty stable. We can see last year's gross profit ratio at 33.42, and the 10-year average and 5-year average are very close to that. Again, gross profit ratio very stable. What Home Depot is seeing happening is operating margins are compressing. On top of this, the housing market is obviously playing a major role in this. There's certainly some correlation with the housing market and Lowe's and Home Depot stock. Mortgage rates are currently elevated. Housing turnover is at historically low levels, and existing home sales are remaining weak, which will reduce demand for home improvement projects. All of these are not bullish news for Home Depot stock. Now, with all that being said, it's still certainly possible that the sell-off has been a little bit overdone. For example, if we jump over to our sensitivity analysis and look at Home Depot, what we can see is over the next couple of years, yes, earnings growth isn't really projected to be too attractive, but after 2027, it looks like they'll get back to the mid to high single digits. So the projected EPS CAGR through 2029 is sitting close to about 5%. Now, what's interesting about Home Depot's valuation right now is we can see they're essentially trading at the exact same average PE multiple that they've historically traded at. So let's project forward what our future returns might actually look like. Assuming they're staying at the exact same PE multiple they've historically traded at and what they're trading at now, combined with the EPS growth rate projection of 5%, what you can see is forward-looking compounded returns don't really look too attractive at their current price. Forward-looking returns don't currently look too attractive with these projections. Now, even if we look at Home Depot from different valuation model perspectives, for example, let's look at them through the lens of a dividend discount model and see what valuation we come to. We'll zoom in and let's assume that they grow the dividend in line with the way earnings are projected to grow at about 5%. We can see the stock will be worth around $274.50, or about 18% lower than the current share price. So the reality of the two stocks we've looked at today is exactly what we talked about earlier. These are two companies that have historically been great dividend growth stocks, but the reality is that a stock hitting a 52-week high can still be cheaper than a stock hitting a 52-week low. Stock price does not equal intrinsic value. And so for me personally, these aren't stocks I would add to my portfolio right now. Again, be sure to check out ProView at the link in the description. It's got a multitude of other features you should definitely check out and is one of the best investing AI tools that I've personally used yet. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.